Hello, everyone. My name is Carrie Larson, and I'm an annuity specialist here at Art Jetter and Company. Thank you for joining us on this highly anticipated presentation from Athene. Today, we'll be talking about the basics of annuities, the annuity spectrum, the advantages of fixed index annuities, and how to choose an annuity based on your client's profile. We're joined today by Scott McClure, Business Development Wholesaler with Athene. Before I turn it over to you, Scott, I just want to mention that if you have any questions throughout the presentation, you can type them into the chat box on your screen. All questions will be answered at the end of the presentation. Without further delay, I'm turning it over to you, Scott.
Well, thank you, Carrie. Thank you very much for everyone taking a little bit of time to learn a little bit more about annuities today. This is Scott McClure, your business development wholesaler with Athene Annuities. Thank you again for attending. We are going to just go over the annuity basics here today with one of our great partners, Art Jetter. So start out. Again, my name is Scott McClure. I am your business development wholesaler here at Athene. Always here to help out with your annuity business. So let's start out. Let's talk just about the basics of annuities. Why annuities? Well, back in 2016, over $220 billion were sold in the U.S. annuity industry in the United States. 117 billion were fixed and fixed indexed annuities. So really, really a great market out there for everybody. The key reasons that we see people purchasing fixed and fixed index annuities primarily are safety and protection, and then also income guarantees. So one of the true benefits of fixed and fixed index annuities are you can't go backwards from any market or index movement. So how are annuities typically sold? Well, generally speaking, the carrier is going to work through an independent marketing organization like Art Jetter, a broker dealer, or a bank. They will supply those. They'll supply their agents with the products. The agent or advisor then sells those to the client on the street. So basically, carrier, IMO, broker dealer, or bank, and then the agent advisor, and then right to the customer. So an annuity is a contract between an individual and an insurance company. In exchange for the premiums paid, the monies may accumulate in the contract on a tax-deferred basis, may be paid out all at once, or in a stream of income payments over time. Some common uses for annuities are to save for retirement. Very, very big retirement savings vehicle. To create a dependable retirement income stream, we do have some great guaranteed products that will guarantee income for as long as your clients live. Also, it's a great opportunity to roll over those funds from an IRA, the old 401ks. We see a lot of business coming from clients who are retiring, want to set up a personal income stream, or possibly just something with 100% downside protection so that they know their money is safe, but they still have a nice possibility for some great accumulation as well. So the different types of annuities, we'll talk about deferred and immediate. A deferred annuity generally accumulate tax deferred for more than 1 year before the payments begin. Often they can be much longer than 1 year. So payments can begin via withdrawals or annuitization. There are a lot of different options that are available today with annuity contracts. Now, we also do have immediate annuities. That's where the income payments are going to start within the first 12 months. Usually they can start, very often they can start very soon in the first month, in the first few months. We also can annuitize a contract. If you annuitize an annuity contract, it converts an annuity balance into a stream of payments. And those payments can continue for a fixed period of time, a period certain, 5, 10, 15, or 20 years, or it can be guaranteed for life as well. So really, that depends on the client and what type of a settlement they are looking for. Also, additional purchase considerations on premium, on annuities. We have single premium versus flexible premium annuities. Now, single premium is going to be purchased with a single lump sum payment. Actually, some can also be purchased with more than one payment, but after the annuity is issued, you cannot add to it. We call those single premiums as well. Some single premium annuities accept additional premium during a short specified period of time at the beginning of the contract. Some contracts may allow for additional deposits, say, in the first year. Here at Athene, generally speaking, you are not able to add to a contract, a fixed indexed annuity contract after the contract's been issued, but you can have as many sources of funds as you would like before the contract's issued. So also we do have flexible premium products, or there are flexible premium products on the market here at Athene. Our max rate is our only fixed rate product, and though payments are accepted for longer periods. With the flexible premium products, you can add to the annuity after it's been issued. So again, with Athene, that's going to be just our straight fixed rate product, the max rate, with additional flexible premium opportunities. So also, issue age guidelines. Contracts often define a minimum and maximum issue age. So often the maximum issue age is going to be between 80 and 90. For a lot of products, it can be maybe 78. And different products in different states will have different maximum issue ages. That's determined by the product and the insurance commissioner of the state. So it's always a good idea to just make sure that you're looking at a particular state, particular product to find out what issue ages that product will work in that state you're working in. So then let's talk a little bit about Annuity Tax Basics. So we're gonna take a look at accumulation versus payout. So during the accumulation phase, interest earnings accumulate on a tax-deferred basis. So annuities are tax-deferred, so any interest or gains that a client makes inside the contract, you will not be taxed on until they withdraw that money. So no tax due until funds are withdrawn. There's no 1099, and it does have a compounding effect because clients get to earn interest on the dollars that they would have paid in taxes. So very, very nice way to accumulate in an annuity with the tax deferral. Now, during the payout phase, when payments are withdrawn, earnings are taxable as ordinary income. Earnings always come out first. It's what we call last in, first out on annuities. So withdrawals before the age of 59 and a half may incur a 10% IRS tax penalty as well. If the payments are annuitized, a portion of each payment is considered a return of premium. So now let's talk a little bit about non-qualified versus qualified. So a non-qualified contract is going to be where the client gives you after-tax personal investment money. This is going to be money they've already paid taxes on. The premium is going to be returned tax-free to the client, but any earnings will be taxed as ordinary income in the year that they withdraw the earnings. On a qualified contract, that's going to be an IRA, a 401k, etc., usually funded with pre-tax dollars. All payments are going to be taxed as ordinary income. Again, all of the money has not had any taxes taken out of it, so it will be taxed as ordinary income in the year that you take it out of the annuity. The annuity does not provide additional tax benefit as qualified money is already tax deferred. So a little bit about the tax consequences of annuities. Now let's talk a little bit about the withdrawal and surrender charges. So on most annuities, annuities are going to assess a charge if the withdrawals are made during an initial surrender charge period. Again, those periods can be anywhere from 3 to 15 years, and they can be a little bit outside of that. That's generally the duration range we see on an annuity. The surrender charge is typically a percentage of the amount withdrawn. Surrender periods vary by contract. The common surrender periods range again from about 5 to 15 years. During that surrender charge period, however, most contracts are going to offer liquidity to your clients for penalty-free withdrawals. So liquidity during the surrender charge periods, most contracts allow some liquidity during the surrender charge period before the surrender charge applies. So that would be your penalty-free withdrawal amount. Most contracts, most common are going to be between about 5 and 10% penalty-free each contract year. Again, that will vary by the contract. Every contract's a little different. Just remember, all withdrawals are subject to tax on earnings, and withdrawals taken before the age of 59 and a half may be subject to an additional 10% IRS excise tax. So now let's talk a little bit about some additional liquidity provisions. In the annuities, many contracts include special benefits to aid with financial needs that arise under various circumstances. So we have some waivers available. Waivers may allow for penalty-free withdrawals up to specified limits if certain conditions are met. So the most common waivers that we see in a fixed index annuity are going to be nursing home or confinement waiver, or terminal illness waiver, or home health care waivers. Waiver availability and terms may vary by company, by contract, by state, where the contract is issued, or by other criteria. So certainly make sure you check the fine points of the annuity contract that you're writing to make sure that you're giving the client all the correct information on any waivers or terminal illness, confinement waivers, nursing home waivers, home health care waivers, that sort of thing. RMDs, required minimum distributions. The tax code requires most qualified plans to begin paying income by age 70 and a half. So your clients can start taking RMDs at 59 and a half, but they are required to start taking them at age 70 and a half. At 70 and a half, the IRS will make your clients start taking the required minimum distributions out of their qualified accounts. Many issuers allow such RMDs to be taken without penalty, and that is true here at Athene. All RMDs are penalty-free, or at least the clients have the opportunity to take their RMDs penalty-free here. We don't penalize folks for taking a required minimum distribution. We also offer income riders. Income riders are available on many contracts. They offer optional benefits, usually available for a cost that guarantee a specific minimum level of income, often for life. So income riders are available on many, many different contracts. The real beauty of an income rider when you use it is that once you turn that income on, we do guarantee that that income will be paid to the clients for the rest of their life if you're using an income rider type of product. So bonus provisions. There are many, many different possibilities for bonuses on annuities. They certainly can apply in many different circumstances. The common bonuses are a premium bonus. So additional value may be credited to the contract at issue. We have many, many different annuities where we can offer premium bonuses up to 15% here at Athene. So persistency bonuses are out there, additional value credited if the contract stays in force beyond a specified time frame. Also income bonuses, so additional value applied if a certain withdrawal or annuitization payment options are elected. So those are also available in different contracts. And again, just have to check all the fine points of each contract that you're looking at to find out what's available. Does vary company to company and contract to contract within the same company, of course. So availability varies by contract and state. So make sure you're checking all of those appropriate features in the state you're working in. Now let's talk a little bit about income guarantees, income riders on annuities. So we do have an option to put guaranteed minimum withdrawal benefit riders or income riders attached to fixed indexed annuities. It is a popular optional feature on many fixed index and also variable contracts, but usually offered for an additional cost. It is going to guarantee a specified level of income, usually for life. It applies even if the contract value goes to zero. So payable as a withdrawal. It is not an annuitization, so the annuitant maintains control over the remaining contract value. That's very important. When you annuitize the contract, you pick a settlement option, and that's set in stone. When you use a guaranteed minimum withdrawal benefit, your client still has complete control over the contract. If they want to change their mind, if they want to surrender the contract or take partial withdrawals, they still have that option as well. The contract defines a maximum amount available for withdrawal, often based on the annuitant's age at the time the guaranteed income payments start. Generally speaking, payout rates increase if taken at an older age. The length of time the contract was held before the guaranteed income payments begin. Income factors typically have a roll-up each year by a specified rate. Our contracts do have that. Excess withdrawals may decrease the value of the subsequent guaranteed payment. So that's important. Once you turn that lifetime income payment on, generally if you take excess withdrawals, it will decrease the future income payments proportionately. So if you do take those excess withdrawals, generally speaking, it will decrease those future income payments proportionally by the amount that you take out of the excess withdrawal. So let's talk a little bit about death benefits on our annuities as well. Many death benefits are available if the annuitant dies before contract maturity. Generally, with an annuity, you can bypass probate if you have a properly named beneficiary or beneficiaries. Money will go directly to the named beneficiary, does not need to go through probate on an annuity. Paid directly to the beneficiary in either a lump sum. Also, we have products where the full benefit base can be paid out over a 5-year period or also over the lifetime. So very, very good payment options. So now let's talk a little bit about the different types of contracts we have. Really with annuities, there's a lot of different varieties. We've got straight fixed annuities, which are just going to pay a straight interest rate. We have fixed indexed, and we have variable as well. Let's take a little deeper look at each one of those. A straight fixed annuity, the owner simply earns a regular interest rate. The company declares that interest rate, and it's guaranteed for the total. For example, we have a 3, 5, and 7-year duration multi-year guarantee product at max rate. When your client gives us their premium, it's going to be guaranteed for that interest rate for either that 3, 5, or 7-year duration. Also, then we also offer fixed indexed annuities. This is where the client will have a little bit more potential to earn a higher interest rate. The interest is based on a portion of the return of one or more indices. So with this one, you're actually going to get all or a portion of an index return. Again, we don't invest the client's money in the index. We simply track the index to see what type of interest they earn going forward. The company defines how the index earnings will be shared, and the company guarantees that the interest credit will never be less than 0. So again, with the fixed indexed annuity contracts, often you'll hear 0 is your hero. In the bad years when your variable clients are losing money, fixed index annuities have 100% downside protection, so your clients won't go backwards from any index movement. Next, let's talk about variable annuities. A variable annuity is going to be an annuity contract that also has variable sub-accounts. So the owner may earn interest depending on the return of the sub-accounts. With a variable annuity, the investment risk is going to be on the client. So sub-accounts are similar to mutual funds and may rise or fall in value. So with a variable annuity, you can gain money, but you can also lose value in your account as well. Variable annuities are considered securities and require securities licenses to sell variable annuities. So let's talk a little bit about interest rates. Fixed interest rates on Annuity Basics. Initial interest rates, the company will guarantee that the initial deposit will earn a specified interest rate for a specific period, typically 1 year or longer. Then our renewal rates, after the initial guaranteed period, the insurance carrier will declare new rates for subsequent periods. Those can be higher or lower than the initial rate. They may have some different terms than the initial period. So some contracts may offer multi-year initial periods, and some may also only offer a 1-year renewal period. So that can change. You have to keep your eye on all of the features of the contracts. They also do all offer a minimum guaranteed contract value. The company declares a minimum guaranteed rate below which the crediting rate will never fall. It's established at the time of purchase and applies for the life of the contract. Also, on some annuities, there are going to be something called an MVA, a market value adjustment. That is a charge that may apply when the money is withdrawn or transferred before the end of the guarantee period. Again, that's defined by the company in the contract and typically related to changes in the interest rates over time. So generally speaking, if the general interest rate have risen since the guarantee was established, MVA will result in a charge or deduction to the contract value. If the general interest rate have fallen since the guarantee was established, the MVA will create a credit or increase the contract value. Again, you only going to see this if someone surrenders the contract early or is taking a larger surrender. Now let's take a look at the spectrum of risk potential here in the different annuity products, guys. So if we're looking for the lowest risk, and we're going to be getting more of a low to moderate return, that's going to be in CDs, bonds, and just straight fixed annuities. Those are multi-year guarantee annuities with just a straight fixed interest rate guaranteed for every year. Those are going to be the lowest risk products on the market. And then we have our fixed index annuities here in the middle. They're going to show no market risk, but they are going to get you more of a moderate return. So a little bit more upside potential, but still is going to have all the safety of a fixed indexed annuity, 100% downside protection. And then also we have the higher risk products, stocks, mutual funds, and variable annuities. They do have the potential for higher returns, but they also have the potential to lose value or lose a chunk of the money or all of the money. So again, these are going to be products where the client's going to take all the investment risk. They're going to pick the sub-accounts, and if they do well, the clients will do well. If the market turns bad, they can lose money or all of the money in those variable accounts. So fixed interest terms, initial and renewal rates. As with fixed indexed annuities include term lengths, generally 1 or more years. Our fixed indexed annuities are going to be, again, between 5 and 15 years. They are going to have initial cap rates assigned to the annuity contract at the time of purchase, applicable to the term selected. Also, renewal cap rates declared after each index term, applicable to the next term. So your clients will get a renewal letter at the end of their term period, letting them know what the renewal rate will be on all of the different indices available. Minimum guaranteed values declared at contract issue and applicable for the life of the contract may be set by a formula. So again, very, very important just to understand that fixed indexed annuities are not in the stock market. We don't invest the money in the index. We simply are tracking the index to earn an interest rate for your client. So interest rates linked to a portion of the upside performance of an outside market index, potential for greater interest crediting compared to traditional fixed annuities, and the indices vary by company. So obviously the most widely used index is going to be the straight S&P 500. The Dow Jones Industrial Average is another big one, NASDAQ 100, Hang Seng, the Euro Stoxx 50. We see a lot of different indices out there. But again, just a way to measure the index to see how much of a change you get from 1 year to the next. So here is kind of how index crediting works in an indexed annuity. The index can either move up or down. The accumulated value is going to increases as the index interest is credited based on upward movement of an index. And again, it's linked to, not equal to, the market index return. So the accumulated value does not decrease if the index movement is negative or flat. So that's a real big point. You have great upside potential in fixed index annuities, but we have a 100% downside cap. So the accumulated value is never going to decrease because of any index movement. So again, let's take a look at how we credit interest to these fixed index annuities. We have 3 different crediting strategies, if you will. One's going to be a cap, one's going to be a spread, and one's going to be a participation rate. So on the cap, interest credit equals the return of the underlying up to the stated cap. So with a cap, your client's going to earn everything that that index does up to that cap limit, and it's going to put an upper limit on what your client can earn. So if the cap, for example, is at 5%, if the index does 3%, the client would earn 3% interest. If the index did 5%, the client would earn 5% interest. If the index did 9%, then the client is still going to earn 5% interest because it's going to be capped at 5%. Again, a cap's going to put an upper limit on it, and those clients will earn whatever the index does up to the cap. If the index performs higher than the cap, then your client will be capped at the cap, and they would get, in this example, that 5% interest credit. Then we also have a spread. The spread, the interest credit equals the return of the underlying index less the stated spread. So on this one, a spread, I like to think of it kind of as a hurdle rate, guys. So let's look at the example. If you have a 2% spread and the index returned 3%, the spread's going to go to the insurance company and the client gets what's left. So if they earn 3%, they would get a 1% credit. If, again, if the client earned 5% and there was a 2% spread, they would earn 3%. If they earn 9% with a 2% spread, they'd end up getting 7. So the spread just comes off the top, and whatever is left is what the client earns in a spread scenario. Now, in a participation rate, this is actually what we prefer here at Athene, because this is not going to put an upper limit on what your clients can earn, but interest credits equal the return of the underlying index multiplied by the stated participation rate. So let's take a look at this example. At a 50% participation rate, if the index earned 3%, the clients would participate in 50% of that returning, they would be credited 1.5%. If the index returned 5%, they would get, again, 50% of that participating rate at 2.5%, and if the index did 9%, if they were at a 50% participation rate, they would get 4.5%. So again, the clients will earn whatever percentage of that index return that they earn. So 50% on a 9% would be 4.5% return. So approach used to measure the amount of interest credited to an annuity as a result of change in the index. So we do have a couple of different ways that we use to interest credit. Common strategies are just going to be a straight fixed rate. We do have those available in our fixed index annuities as well as our fixed indexed options, but we do always offer a straight fixed indexed rate as well, fixed rate. We also offer a point-to-point. So that is going to be we're going to take a look at where the index is on the day the contract's taken out. We look at it 1 year later. We actually do have 1 and 2 year point-to-point, so we can do it as a 1 year point-to-point or a 2 year point-to-point. And we look at the increase from that specified date to a specified date 1 year later or 2 years later. So then your client will get that amount of change in the index between those 2 points. We also offer a monthly averaging. We look at the change, the percentage of change in the index comparing the beginning index value to the 12 monthly average index value. So with this one, we go back and we actually look at the monthly average divided by 12, and that is going to be the interest rate that your clients earn that over that 12-month period. We also then offer a monthly cap. Same as the point-to-point strategy, but on a monthly basis. So each month we're going to look at what the index did, and we're going to get that monthly reading. After the 12 months, we add all 12 monthly percentages together, and your clients get that option as well. So the most common are going to be just your straight point-to-point. Seems to be the 1 and 2 year strategies seem to be the most popular. But again, we do offer many, many different crediting strategies, so you and your clients can pick the ones that you feel are going to be best under your circumstances. So just to summarize, an annuity is going to help with safety and protection, provides upside potential with no risk of loss. Again, all of our fixed index annuities have 100% downside protection. We do offer income. We've got income riders that will offer guaranteed income for life. Annuities are tax deferred, so your clients will have the benefit of tax deferral. We do have a number of different death benefit options. Again, these are going to vary, folks, depending on the specific contract. And then we offer a lot of different liquidity features as well. We also have the riders on there for free withdrawals, nursing home, terminal illness waivers, confinement waivers, all available on the different annuities we have here. At this point, if you have any questions, go ahead and put them in to the chat, and we'll be happy to answer those. If not, Carrie, I will throw it back over to you. I want to thank everyone at Jetter for allowing me to spend a little time to go over fixed annuities with you. If you have any questions,
Okay.
please give your marketer at Jetter a call. And this is Scott with Athene. Thanks very, very much. Back over to you,
Thanks,
Carrie.
Scott. We do have a couple questions here that I want to address before we end here. Someone is asking if we get any continuing education credits for this webinar. I believe the answer to that is no, not on this particular webinar. No continuing education credits.
Right.
Someone also asked about an illustration, and I would like to say that anyone can give us a call here at Art Jetter and Company, and we can get you an illustration, a sample illustration, and walk you through that over the phone, one-on-one. So we'd be glad to do that if you want to call us after the webinar. And someone else also asked about the recording, and yes, this is recorded. We will send out the webinar to anyone who would like to see that again. And I have another question here. How is a customer paid if the contract value is $0? Not real sure about that.
Well, I think they're talking about those extended income guarantees. If you have a lifetime income rider, and if your clients are just taking those lifetime income payments, even if the money that they've invested or any gains on that contract, if we've paid them back all their money from taking income payments, that is the true benefit of the income product. We, again, will pay them as long as they live at the same rate. So that is the true guarantee of the lifetime income product, is your clients cannot outlive that income. It's income certainty in retirement. Essentially what it is if they run through all their money and they have longevity in their family, once they run through all their money, we pay them, the insurance company pay them out of our pocket. That's the guarantee we make them for the lifetime income product. So we just continue to pay them as long as they play by the rules and take those income payments. We'll pay them as long as they live. So it's a great way to supplement Social Security or to set up a personal pension for folks going forward that they can't outlive. Okay?
Great, thank you. That is all of our questions. I want to say thank you, Scott, as well as everyone else who joined us today. We encourage all of you to start thinking about people who are a fit for an annuity product. To get appointed with Athene, please visit our website, www.jetter.com, and click Get Appointed. Our team is standing by, or if there's any further questions or you'd like additional training, please give us a call at 800-228-0008. Again, thank you for attending and enjoy the rest of your day.